Hello everyone. I will discuss Chapter 7 in this lecture. The chapter is about financial operations of insurers. These are the concepts that we will cover in this chapter. So we start with property and casualty insurance. So their balance sheet is typical of any company. The total assets should match the total liabilities and the equity. This is a typical balance sheet of a property and casualty insurer. Primary assets of an insurance company are financial assets, things like premium as well as investments in different financial assets. Now we look at the liabilities. The liabilities consist mainly of reserves. We have a loss reserve, which is the amount earmarked for claims which have been reported but not paid, claims which have been reported, not yet adjusted, and claims which have been incurred but not yet reported. There are also case reserves, which are loss reserve established for each individual claim. So we can determine the case reserves based on three methods. So first is the judgment method, where each individual policy is evaluated and a reserve is calculated. Then we have the average value method. So in this case, we have uh, an average value assigned to a group of policies. And then we have tabular method. So in this case, the loss reserves are determined based on data derived from mortality, morbidity, and other insurance data. We also have loss ratio method to determine the loss reserves. So in this case, the loss ratio method is applicable for a specific line of insurance, and the formula uses the expected loss ratio. So we also have loss reserve for incurred but not reported cases. These are the ones which have occurred but have not yet been reported. We also have something called the unearned premium reserve. So whenever we take an policy, we pay the premium in advance. As the policy duration progresses, the duration which is covered accounts for earned premiums, and the duration which is pending accounts for unearned premiums. For example, I can take a policy for 1 year. I pay the premium in advance. After 4 months, the premiums corresponding to the first 4 months is earned premium, and the premium corresponding to the remaining 8 months is unearned premium. So the companies have to make some allocation for the unearned premium. So it will help to pay for losses during the remaining period of the policy. It can also help to pay for refunds in case the policy holder wants to cancel the policy. And it is generally done on a pro rata method. As I mentioned, for 4 months, we assign it as earned premiums, and for the rest 8 months, we must assign it as unearned premiums. The final concept is the policyholder surplus. So this is the difference between the insurer's assets and liabilities. The higher is the assets with respect to the liabilities, the better is the financial position of the insurance company. Now we move on to the income and expense statements. So there are two principal sources of income. One is from premiums and the other is from investment, the returns from investment. Earned premiums are for the period for which insurance has already been provided. Think of the previous example, 4 months have passed, so earned premiums correspond to 4 months. And expenses are related to claims adjustment, paying for losses which have occurred, paying commissions to agents, taxes, and so on. So this is the typical income statement of a property and casualty insurance. Now we look at loss ratio. Loss ratio is the ratio of incurred losses and adjustment expenses to premiums earned. Note one thing, both the numerator and the denominator are for the activities which have already occurred. Premium earned for the duration which has already passed, and the numerator is for expense for losses which have already occurred. Expense ratio is equal to the company's underwriting expense and written premiums. Written premiums is the premium which has been collected at the beginning of the policy, and also underwriting expenses which happen at the beginning of the policy. And combined ratio is the sum of the loss ratio and the expense ratio. We also have investment income ratio. So this is the investment income by the earned premiums. And we get the overall operating ratio by subtracting investment income ratio from the combined ratio. Combined ratio we have discussed in the previous slide. That's all for this lecture. I will continue with the rest of the chapter in the next lecture. Thank you.